very few developers want to go into tertiary markets, but and there's less institutional competition. So large hedge funds don't want to put money out in those areas. It's historically been considered a risky asset. So the result is structural supply constraints. So we don't see this if we don't see the supply there and the demand even stays the same as inflation starts to come in, as interest rates compress, income will continue to increase. It'll be easier to make those rent increases there, and the lack of supply makes it a perfect opportunity. So, and in a lot of the tertiary markets, it simply doesn't pencil to build new Class A product at workforce rent levels. So, the majority of the population there's workforce housing, workforce people, and you're not going to see somebody go in there and build a lifestyle property, a property with a bunch of lap pools and massive gym equipment and that type of stuff come in there and outperform a B or a C class property. So why it makes sense? There's essential workers, there's a local service economy, lower rent to income ratios, and sticky tenancy. These people, generally speaking, don't move. So you don't have to demand a lot out of them, and you don't have the supply that's going to like push them out of that particular building. So it's a necessity product. Again, like I said, it's not a lifestyle product. So there's not a lot of, if you go buy a building in kind of a tertiary market, you don't have to do a ton. You have to get that 25 to $50 annual rent escalation and make large NOI. That makes massive NOI impact with net operating income impact, and generally increases the valuation of a property.